And here we are, here we are.
Yep. Hi guys, welcome to another Learn, Grow, Invest meeting. This was not a planned meeting, I'll say that, but when the market provides you with opportunities to speak, then you take it. So with me are two guys that you should know very well. We have Chike Verwe and we have Justin Scott representing 876 Invest. So I'm just gonna kick things off with a word of prayer as we normally do, and then we jump right into it. Lord, we thank you for this day. We thank you for everything that you've blessed us with. We thank you, Lord, that it is you who gives us the opportunity to produce wealth. So, Father, we pray that as we go through these offers, that you'll give us insight, give us revelation, that we may make the best decision for ourselves and our families. In Jesus' name, Amen.
Man.
All right. No cake and sorrel, Dennis, unfortunately. I say Romain was here from about 6 o'clock. Well, 6:16. I say Dane is here. And so guys, I'm gonna ask you before we jump right into it, please share this video, share the link with others, help us grow as a community. And definitely stay tuned for next year. We're gonna be doing a lot more sessions like this. We're gonna be working with a lot more persons. Some interesting meetings are being worked out right now. So look, stay tuned for those. And I'm gonna hand over to Chike right now. And yeah.
All right. So good night again, everyone. Once again, as Jermaine said, this was completely unplanned with what we were doing, and I am absolutely grateful for Justin joining us from the 876 Invest team for this one because we believe we've got some good tidbits for you guys. We know that these two companies that we're about to speak on, they have been ventilated by many different people with their viewpoints. First and foremost, we get the legalities out the way. We are not financial advisors, so this is completely an analyst and opinion from our point of view. This is not a recommendation for or against any of the entities that we will be discussing. So with that, we want to kick it off. So tonight, as you saw, we'll be discussing the APO of Derrimon trading, and we'll be discussing the Alliance IPO. For those who have been keeping up with the news, I'll just get it out there for what happened today earlier on. Well, the first one was that due to matters pertaining to the principal shareholders, the Alliance IPO has been delayed. It's suspended until January 28th. But that doesn't mean anything untoward. It just means they have to clear up whatever is the matters that they need to. In my personal opinion, I think that's a great thing to give us some more time to prepare, especially coming out of the holiday season. So that's good for us. And with this discussion tonight, you also get to see maybe another set of insight that might not have been presented by others. As this will be a little bit technical. We'll try to not be too technical about this, but this will deal with the numbers tonight. This will deal with the performance being graphically shown on charts, etc. So that's how the discussion will center around. And then the second one is the Derrimon trading. They've had their APO out, but there have been different things that have happened for today. The most recent is that there is also an offer of $2.38 on the shareholdings from the Mayberry side, right? So, and that's about a difference of 2 cents. Justin, I remember correctly. It's
Yeah,
about
just
2
about.
cents.
I think it's about $2.40 for the general shareholders who would not have
Get to participate.
Right,
Yeah.
right.
And the biggest thing about the Mayberry offering is they stated that all orders will be filled. So that's huge. That's huge if you're really thinking about going into Derrimon and taking a holding of Derrimon. Yeah, most definitely. There are more than one option now available, or options available to you. So without further ado, let me just,
All roads lead to gains, yeah?
that's true. It really does, and it just depends on your flavor. Are you going short? Or are you going long? I mean, you know me already. Everybody knows me already. I'm completely long term. So from every standpoint that I'm looking at. But as we were preparing for this meeting last night, Justin and I had some insights that we saw that we think are interesting, both on the Derrimon and on the Alliance side. So we'll kick off with the Alliance. Sorry, we'll kick off with the Derrimon first, based on what we know. So, Justin, you wanna? I'll share my screen, and I'll put up the prospectus first, so that we can, if we want to go through that, and you want to talk on those points, because I wrote down some of the points for the Derrimon stuff, just in case you might not remember.
All right.
So,
first, I want to take it a little bit lightly, just give a little bit of a background. Derrimon Trading Limited, headed by Derek Cottrell, I believe that's how the name is pronounced. Huge distribution company, as they'll actually put it, one of the fastest growing distribution companies in the country. They are in possession of Caribbean flavors and fragrances, which manufacture artificial flavorings for scents and flavors for the use in other manufactured goods. They are the largest owners, I believe, in Woodcats, which is the company which manufactures the wooden pallets used often in construction, distribution, deliveries, and whatever the use you can find for wooden pallets. I believe they are also There's a supermarket in it, right?
Yep, Select Grocers.
Select Grocers. That's the one. That's the one. So they've been very adamant, and they've been very well straightforward, and straightforward with the thing, saying they are, there we go, 100% ownership. Thank you, Glenville Hamilton, right? So they've been very straightforward in their acquisitions, in their determination for making use of the tax rate that they have to, as much as they can, expand the business lines, whether it be horizontal or vertical, and make use of their system as a distributor. Which really does make so much sense, because Sampars, right? So, distributions, the wooden pallets come in handy for making moves. There's also Sampars. That's what's the name?
Supermarket. No, there's a supermarket or a chain.
I know there's also the lights. What is the light under? Trying to remember. I can't remember the name at the moment. It's escaping.
Well, here we go. Well, we got it. The company's businesses. Here we have it. So we've got the distribution side, which is for fast-moving, as it's stating, fast-moving consumer goods. We've got the retail and wholesale. So we've got these brands being distributed by them: Nestle, Sun Powder, Blue Power, Golden Brand, Buster, Chubby, and Cool Kids. You've got the retail and wholesale side, where the company operates the Sampars cash and carry outlets and supermarkets, and then also the Select Grocers, as they talk about it. And then they have the other operations, which we talked about, which you mentioned, the Woodcats with the wooden pallets.
Mm-hmm.
And then, not forgetting also CFF, in which they have, from what they said, they have the general cleaning, sanitation purposes through CS, and general cleaning and fragrances through CFF. Mm-hmm. So yeah, that's really the company, as you said. Yeah.
Distribution, retail, wholesale, and manufacturing.
Manufacturing. Right. Yep.
Really strong. So let's see. SM Jalil, that's what I was trying to remember. Right.
Mm-hmm.
Yeah.
So they've got a few ventures that make up that group of Derrimon Trading Limited itself that sets them. To jump back in, what persons might also might have overlooked is they also give inside of the prospectus a little insight into the company, into the subsidiaries that they have. The three main subsidiaries that they hold, they've basically, and I'm scrolling a little fast, guys, so apologies for that. I'm just trying to get down there. So these are the three main subsidiaries that they have. And this is the current ownership of those subsidiaries in terms of their holdings in them. So for CFF, they've got 62% as of 2019. For Select Grocers, they've got 60%. And for Woodcats, they've got 100% ownership in that. And we like this because this was a discussion that we were looking on. Because this pallet industry for Woodcats, the pallet industry itself is technically it's pretty much a monopoly. They're the main supplier, and to my understanding, they're the only supplier of these pallets. So, and these pallets have to go to many different companies for the movement of goods, etc. So this is a big revenue earner for them, coming in on that side. So, and everyone will notice that they actually went out to buy this one 100%. They had a holding in it before, and then they went out to buy 100% in it, which, in my view, or my opinion, that shows that they strongly believe in the potential of this company and what it could bring them long term down the line.
Absolutely. There was September 6, 2018, right?
Yeah, so September, so right. That was when they did the full acquisition of them. Additionally, too, a little bit further down, when we go into, there's a part here that we looked at last night. It's not it. The financials for the subsidiary. We will see that the companies themselves on their own make some good money by itself in terms of performance. Let me just find it. 1 second, everyone. Should have remembered what page it was on. Those are, we'll get into those in short order. That's the summary of the accounting policies. It's the investment properties. Come on, where's the financials? Are we missing something?
Scroll up a bit, because I think this is in the notes area.
Yeah, it was in the notes.
Oh well, there's the table of contents.
Right, let's see.
Yeah. So I can get down into the notes and see the financials. And so it's broken apart.
All right. This is the entire income statement. This is the entire statement. Yeah, that's it. It was here somewhere. It's not in this one. Well, notes. That's 11 to 28, but we were just on it. Page 11 to 28. Let's see what we get. Because off the top of, I don't want us to go off the top of it, but I remember that Woodcats does just over 480 odd million in revenue, right? No, it's 18. Yeah. No, we don't have this. Surprisingly, it's not in this. Huh.
You want to just search Woodcats and
Okay, let's go.
Yeah.
So that's that. Opportunities for growth, right? So this is the talk about the opportunities for growth on Woodcats. It's not there. It's not on this one. I'm surprised about that. I'm wondering.
Oh wait, hold on. What was this a while ago? Scroll up a little bit. I think that at least one right above this one. Yeah, I believe there.
This is talking about how it impacted them.
Yeah.
And we're gonna get into that very shortly in terms of how that impacted them. All right. Well, once we find it, we'll find it, and we can bring it back up. But what we really wanted to discuss now, guys, is well, this is from the technical standpoint. So what's going to be brought up for you guys is going to be a bit of the 1 second. That's the alliance, but that's not what we're looking at right now. Give it a moment. There we go. So this is Derrimon Trading, and we're looking at Derrimon Trading's company financials. I'm wondering if everybody is seeing it. Just to let me know if everybody is seeing it clearly. All right.
I'd say zoom a bit if you can.
Oh, is that now? That's good?
A little bit more.
A little more.
Viewing from their phone, so depending on where you're talking about, just zoom into that area.
Yeah.
Okay, all right. Let me just see here. I don't want to get too big because the numbers then it comes off the screen and then they. All right, this let's see if we can work with this here. So what we were looking at, this is straightforward, guys. Basically we did this the first time when I was showing you how we basically do the analysis of companies as simple investors, value investors, etc. So there's some things to take away that we found about Derrimon Trading. Basically, this company does its performance pretty nicely. They've grown their equity year on year since they've listed from 2012 to, as you can see, their equity growth is here. And since they've listed, they started off just $104 million, and now as of 2019, they're at 1.3 billion. Right? They've had some dips. 2018 was a better year with 1.6 million, but coming out of that still good for the equity for the shareholders. Now, as I was expressing to Justin, where I have concerns to is on the debt side. As good as this company looks, I am very concerned with the fact that since their listing, they've either done loans or debt in one form or the other. So for those who know, one of the first ones that was there was not one of the first ones, but one of the debt holdings that they undertook was the 11% preference shares, right? And that was great. So for an investor who's coming in for preference shares, the return on that at 11% was really good up to 2018 when that preference share ended. And then they came back and did another preference share, which was for 9%, right? In addition to that, they have got a number of loans that they took out with various institutions, and those loans become due at various points. But it's still something that, for me as an investor, and as you can see, we're normally told that when you do ratios, you shouldn't take them in whole by itself. But still, I still question the fact that their debt to their assets, their debt to their equity, would appear to be, well, they've kept their debt to asset very steady, but their debt to equity is starting to rise back up again, based on everything. But then they've got some other good ones, such as their ability to hold cash, their current ratio, which is positive, is 2.23, and for those who know what the current ratio is, that's basically just the division of the current assets from the current liabilities, basically. And that's by my threshold that I use currently at 2.23. That's pretty good for them. It should be noted, though, the reason why that is that good is also because of the debt that they have on their books. So we're going to get into that shortly when we get to their operations of itself. But they've got other stuff. I've also got a little bit of concern in terms of, even though the equity growth has been good, it dropped back a bit here. So as you can see, the difference between 2018 and 2019, there's that drop off. And even still, in comparison to 2017, right, that was a really good year for them in terms of their equity growth. And then it started to come back down again. So I don't know, Justin, you want to chime in here?
Scroll up a little bit.
we want to look at,
On the
right?
point of the debt, you can see that, or if you're looking over at short-term debt, it was sporadic. For example, the first big jump would have been in December 2014, where would have moved from 32 million, 77 million to a whopping $429 million in short-term debt. Where that would have that's one point with that one. But yeah, at that point it was sporadic. There was a big jump in 2014. I'm sure there was a acquisition there or
Mm,
for some purpose. Then they dropped off in 2015 and then they gradually built it up going further up into 2018, 2019. You can see
yep,
2018,
yep,
which is when they would have acquired Woodcats,
yeah,
right? And that big jump there, and you can see it even reflected into the changeover from total assets in 2017 to 2018, which would have represented the actual increase in assets that Woodcats would have allowed for them.
right,
So yeah, so as you can see, they have been very aggressive in terms of making use of debt to invest into their businesses, to increase their company lines, and to me, for a distribution company, I personally I find that encouraging that they're willing to, go across the lines and not really go across the lines, but to put themselves out there to really increase what they're going for and to expand lines vertically, right?
true, true,
Yeah.
true. I definitely take that agreement. You can't get anywhere without spending some cash. So dependent on where you get the cash
True.
from.
True.
I am just concerned about its growth though. But as we were talking about that, one of the hit the gems is next year. What happens with that 9.5, that 9% preference share, and the fact that it ends in March of next year. March 21st is when it ends. And I am curious to know if they're going to come back to market with a new preference share, or
If
are
even
they going
same
are they
rates.
going to just let it slide and work off their own merit with the revenue at this point in time and not do so? But trends suggest that they more than likely will, because they've done it every year. From 2013 come forward, they've taken some kind of debt, some kind of loan or preference share, etc. every year from 2013 come forward to present. So
Yeah.
I'm
Been
curious to
gradually
see what
building
that
cash.
would.
Gradually
Yeah,
building cash from 2017 come up, and I
right,
don't know if that would represent, well, like we do know because they actually told us in the prospectus what the purpose of the raise was for the purchases or for the acquisition of two companies out in the US, pay down of some debts in addition to, was there another company they're purchasing? I'm trying to remember.
I can't remember. I can't remember in the discussion.
But yeah. If I know
But
that
they,
with Derrimon, it's typically to support their vertical lines. So trust me, so they'll be out in expanding further into the foreign markets, increasing their holdings, increasing business lines and optimizing business lines.
right. But we're gonna let everybody see what these numbers looked at chart. Another key thing to pay attention to is they do, for everything what they were speaking about, they do put their money to work. So if you take a look at capital, their capital employed, they have applied it every single year very nicely. Up to 4 billion now, in terms of how they disperse it. So looking at them from that standpoint, if we get down to graphing them, the trend suggests though that their debt to asset ratio is going to start to come back down at some point in time, based on the line. Even though it has gone up, it has started to go back up a little bit between 2018 and 19. But we'll see. Debt to equity is definitely has been on a downward trajectory. We'll see again come 2021 what they do. What are the other things we want? Cash. Oh, there we go. This is good. This is
Massive.
good look. Yeah, this is a good look. Your cash ratio is climbing like that. That's a really good look. Based on the numbers, and same for their quick ratio, which is their asset test, which is basically the removal of their inventories from their current assets, basically to get a better view of how they're what kind of debt they're really made up of. That's looking pretty good. Same thing for the current ratio of the company. That's also trending upwards as well too. This looks pretty good. If you were to look on try to do a long-term trend projection, this so far, you know, I guess it wouldn't be remiss of us to not show the questionable parts as well. So this is their equity growth, and this is something to pay attention to as a shareholder. Their equity growth has bounced around the place, and I have my concerns about the fact that they had really good equity growth as I said, in 2017, and a good growth rate of itself. This growth rate is basically at close to 200%, and then it just precipitously started to fall off. So we'll see in 2021 what they have to bring to the table. Of course, as we said, the capital employed, yeah, that's climbing. That's always something good to see. Vice versa, conversely, though, we still must pay attention to our equity versus our debt. That has been climbing. The debt has been climbing steadily. We'll see how that goes. Because with the APO money, with the APO take up, that's not really debt. That's just fresh cash. So, right. So yeah. Do we have any other graphs here? We had talked about this, Justin, last night.
Yes.
Goodwill.
Right. This is
So
massive.
yeah. So guys, goodwill is an assumption. So they assume that based off of their purchases, etc., is an assumption of what the company would be valued at. If I have that wrong, somebody can correct me. This figure, if it keeps rising like that, you know, in my studies of American companies, was something to be cautious about. As you see this number rising, because again, it's an assumption. So we might want to pay attention to this if it keeps going up like that.
But as I said, the one in December that large spike in December 2018, as I said before, would have coincided with the purchase of Woodcats. And being I wouldn't say it's too much of a stretch given the industry that they're in, given the fact that Woodcats is, as you said, one of the only producers of these wooden pallets. And then given the projections of construction to come in the coming years, still have a whole lot of construction lined up. When you think about it from further than just the numbers and get into actual space that Jamaica is in at the moment. You drive around anywhere in Kingston, you see a whole lot of development, and then we're trying to segment into rural developments, meaning further out into the Southern Highway, going across Mandeville, I believe, in addition to the one that they're sorting out over by St. Thomas. That's St. Thomas to Portland stretch. It's massive. Given the situation we're in right now, you know, people have to be moving a bit away from the traditional investment methods that they would have been in. You know, given that tourism is a bit down. So a lot of people that would have been in the rental income industry have to bear that in mind, whether it be current properties or the development of future properties. But as you know, investing is based on looking at situations as they are now and trying to derive value going forward. So seeing the lull that we're in right now, probably if you can find good deals on investments, good deals on real estate, you can start a development from now in preparation of a return to normalcy or a return to that industry, I should say.
I am also looking directly about in terms of Woodcats itself, in terms of the push from other companies, other distribution companies, manufacturing companies that will be upping their production of their products. They're definitely going to need those pallets as well too, for either storage or movement of their goods from warehouse to warehouse or to truck or wherever it's supposed to be distributed to. right? So that's also something good coming to them.
As a matter of fact, most of the bigger manufacturing and distribution companies have expanded warehousing space, have expanded storage space, have expanded the factories.
True, that's right.
Yeah, recently. For example, AMG recently expanded to, I want to say, Retirement Road. Honeybun expanded in 2019 their
Right.
warehouse because we're operating at full capacity. I want to say Separate and Grace Kennedy as well, but I'd have to double check that. But it's on my mind, so probably can check over and add the links later, post it up in a group later. But yeah, I believe that's there. So that is also a revenue line for them as well.
That's true. And the last three things, we were looking at the accounts receivable side. For me, there's a bit of concern with this because your accounts receivable increasing on your balance sheet questions how much you're getting in payments from your customers, and that basically started from in 2017. So we'll see. I'm not too worried about the accounts payable, even though it was going up. That's normally standard, and it's actually coming back down. 2018 between 2018 and 19. So we just give that. But this is the other big one. This is the final chart that is for the balance sheet side of Derrimon. This is big, and you can only expect this to go up even higher when the APO is done and subscribed, because that's fresh cash for them just coming in right there. It's just going to be really good. So they were cash rich before in terms of being loaded with that. They're going to be even more cash rich with the APO. So moving on from that side, so the next side of them, this is now we're going to deal with their revenue, with the overall revenue line and the generation of profit, the things that we like to talk about, the net profit, etc. Let me make this bigger for everybody to see. So let's look on some stuff here. The most important thing was they are able to do. They've been steadily improving their sales and revenue. This is before listing. It was 4.7 billion at December 12th. These guys are up to 12.6 billion dollars now. That's huge. That's really huge. But I also have concerns about their cost of revenue generation.
Yeah, very, very slim margins. Very
yeah. It grows in line. It grows in line with their revenue. And that for everybody who's seeing this has direct impact on the final net profit. Additionally, too, their operating expenses, by the time we get down to the end of it, to move from $12 billion, their net profit then comes down to, here it is, net profit line, $209 million. That's a lot of money being taken out. And we were trying to figure out if this was basically because of the preference share and all of the other debt that they also have to undertake, that they have to pay out, that it's just being extracted because of that. But that's somewhat of a concern for me, at least. I don't know, as you said. And then the next one, I'm sorry, I want to make this a little bit bigger. So guys, pay attention to it. So cash flow from financing is where the company, so CF from Fin, the term I've extracted here is cash flow from financing. And this is basically where the company on the cash flow statement pays all of their debt down or takes in new debt. The fact that the number for every year after 2012 is positive means that they have been taking on debt. So let's take a look at that right now. As of 2019, $1.956 billion positive on their financing.
That's right.
That's not to say that they haven't put it to good use, but still, it as a long-term investor, as a value investor, you have to ask the question: extract this money that they keep getting from financing, and what does the picture look like for them standing on their own based on their revenue generation? It's a very important, well, I believe it's a very important question to ask. You know? So, and it has an effect at the end of the day, because when you come down to the indicators that we want to look on. So, for instance, before you get to their operations in terms of revenue, their gross profit looks really good, right? Immediately, because of how their operations are structured, when you get to their operating margin, everything just falls off. You move from 18% of gross profit margin right down to 4%, basically 5%. That's a huge deduction right there. You know, huge changeover. Justin knows I like to look on things for the money side. So free cash flow is a very important indicator for me. Everybody knows that I like to look on free cash flow. And that is basically how much money can be extracted from the business without impacting net profit, or having to go take a loan, or having to dip into your retained earnings. And that hasn't been positive. So that's a question to ask in that as well too. Actually, it has only been positive once. It's normally negative, right? And it's negative and growing again.
As we can
Similarly.
see. Yeah, because just based on how thin their margins are in general.
Right. You know, the shareholders will be happy though, because return on equity, which is your investment into the companies, is pretty nice, 21% as of December 19. Thing I have about that is that, and we'll get down to that part shortly when I scroll down further, they haven't paid a dividend since 2018. That was the first time they paid a dividend, and we talked about that last night. That was a 2.7% payout ratio based on the calculation. And then when they got to 2019, that got chopped from a 7-cent dividend to a 1-cent dividend, right? And then COVID hit this year, so I think their dividend was, I think they did a 2-cent dividend, if not correct. But yeah, it's not favorable in my view as an income investment for income shareholder, you know, with the dividend, unless you're holding a lot of units, that is though. So that's also the other side. It depends on the number of units that you're holding. So yeah.
But that's as I said, those would be for the income investors, the dividend investors, whereas some others may not be too concerned about that. Seeing as
be looking at price.
Yeah, given the fact that they tend to use their cash and the cash pretty well in terms of capital allocations. So you wouldn't be too concerned about that when you compare it to, say, the return on equity, because return on investment. So 21% for 2019, not bad. Compared to, that's somewhat a little bit below what the market itself would have returned for 2019. I think that was about 30%, but still, you know, still pretty fair. Especially based on the still margins that they're producing.
Yeah. And we do see, and it's proven there as well to what you just said with the retention. They keep back a lot of their cash. So this is their retained earnings here that we extracted, and this is the retention ratio, which is the calculation from their retained earnings. The retained earnings against their net profit, right? And as you can see, it's pretty high.
Over 200% from 2030 come right up.
Yeah, come right up. And of course, as we said, we did the dividend yield, not or the payout ratio is the dividend. The payout ratio is the dividend payout. Yeah, that could be better, because at 300% versus you only giving you 7%, it improved 9%. But I mean, yeah, in the grand scheme of things, I guess you'd have to wait. You're gonna have to wait a little bit longer. But carrying these same figures now and these same percentages down to the charts. This is the charts that we're looking at. So here we have the gross profit margin chart versus the operating profit margin, and the numbers speak for themselves. You see the gross difference, between the two. I personally would like to see that closer. that would be indicative of a more efficient business to me. But I can't balk at it. This is actually nice. I liked this chart very, very well. Their net profit versus their net margins has been growing steadily. 17, 18, 19. So this is something positive to look forward to in terms of the growth of the company, that we can expect. What else do we have here? Yeah, we have the free cash flow versus the return on equity. Yeah, and we spoke about that last night in terms of finding profitable companies that we want, companies with high free cash flow and high return on equity. Well, yeah, that speaks for itself. And then we have our return on investments. That's a little bit down. And see, everything here, guys, is strictly from the numbers. So there's no opinion behind this. This is just what the formulas calculated out to, and then the charts that develop from them. So you have to take it as it is. And as always, again, we'll say, check with your financial advisor to see if this corresponds properly, and how you feel, So return on assets. Well, even though this is coming down, this trend still suggests that it will pick back up. Similar for return on equity. So I think that's good. I think that's a good thing. What do we have? What else do we have? We have and I'm still hoping that it's not too technical for everybody. What we have here, this is our return on our investment that you talked about, Justin, just now, that you mentioned briefly, against the company's return on assets, right? It's coming back up. Well, the return on investment is coming back up. Return on assets is coming down. I mean, projected. We'll see where it goes if it comes back up. Yeah. So I think that's about it for Derrimon. Oh, this was crazy. This is their dividend payout. But of course we know that they only started paying the dividend in 2018. So of course this chart is going to look like this.
Yeah.
Against their dividend payout. Yeah. So it's going to skyrocket. Yeah. So guys, that's Derrimon. So to recap, even though you've seen with Derrimon, I mean, solid revenue growth has been going on for the long-term investor. Though, if you're looking for income, the dividend payment might be a bit low for you, depending on what you hold. But with the prospective investments that they've made in Woodcats and what is to come in 2021. And the fact that they've allocated their capital accordingly, yeah, we should still be looking at this to see what prospects holds for them, because they definitely know to put the money that they get to use.
Right. There was actually a really good point that someone had posted in the chat earlier, that they were hindered by the Marcus Garvey Drive construction. So as a distribution company, that entire stretch of where they're located was almost compromised in a way by the additional construction of Marcus Garvey Drive constructing yeah.
Okay.
Trying to remember the exact time period. I believe it was from 2018 and only finished recently into 2019, late into 2019, if I remember correctly. I could be wrong. On that, but yeah, there was some hindrances there.
So then that definitely means that there's prospects. There's good prospects for this. I mean, coming out of with everything with COVID and all of the construction is now done. Marcus Garvey is done. They're firing on all cylinders. Let's see in truth. It should be pretty interesting indeed.
Yeah. It should have been around the time they chose to start paying dividends after acquiring. But that's just some afterthoughts. It's all some afterthoughts, right? So as I said, it's making a look at what we see here before us now to make some educated decisions for the future.
Right. And remembering as well too, next year the 9% preference share expires or comes to an end. on March 21st. That will have an impact on the financials as well too, because they no longer have to make that payout. That should be huge. That should be huge.
Guys, it's not preference shares are different from the payments made out to preference shareholders are different from the payouts made to regular shareholders, right?
Right.
Whereas their dividend policy is paid out from the net profits, which is after tax, after everything, after blah blah blah. It's different from the payout to preference shareholders, right? Because they see that as that's debt, that's short-term debt, that's liabilities that's paid out.
Yeah.
So you know, so it's something to make note of. So boom, you're taking about over 30% of what they're gaining from the APO, paying off some debt. Preference shares expires next year. And then what you should be looking out for is do they go back into the preference shares? Do they employ it again at the same rate? Will they drop the rates this time? Will they continue going out? Is it going to be what's the
next move to acquire more cash?
There we go.
That should definitely have I'm thinking it should have an impact on this chart that we're looking at, which is the retained earnings, because that's going to be more. That should be more money coming back from that net profits, and then funneling over into the retained earnings for them. So that's supposed to be another improvement as well. But again,
that's right.
We'll see what they do in March if they come back to the market for another preference share, or they decide not to based on the APO intake, and just work with that. I'm hoping that they do. I'm hoping that they don't come back and they just work off of the APO intake and just let the revenue and just shore up their business in terms of their business process of operations. Like get that operation expense level down, so that they can keep more. So
that's right.
We'll see. Yeah. All right, guys. So that's one down. The next one we move on to is Alliance Investments. So I want to take this one. Although this is, as I said, this one is suspended until January 28th, but it gives you guys time to
look further through the prospectus, make an educated decision. If you're sure about it from before and you're still sure now, then it gives you some more time to amass some cash. You can make your decisions, right?
Yeah.
So
we must remember the purpose of this one. This is not really for debt. This is just the two of the principal shareholders deciding that they wanted to take a little cash off of their hard work, off their hard venture, and sharing a bit of their company with the general public. In my view, this is a gift, and we'll get into that further, because I like companies that come to market without the backdrop of debt being the main thing of why they're coming to the market. So to see it, I don't know why they couldn't extract it otherwise, but because I don't know the workings of that. But yeah, this is as you can see, and I brought this up specifically. The amount that they want between the two of them, in terms of between the two companies, Melwood Holdings and Willow Capital, is like a dent. It's a smidgen of what they're giving up. So, and then you have all of the other persons, who are going to get. So this is after the shares are issued. I'm sorry. Let's look at before the shares are issued. Yeah. So this is before the shares are issued.
Right.
It's going to look like this. So
still
these guys
that they're just selling out now to just cash out.
Yeah, it's
there's absolutely nothing wrong with that, because the purpose of a business at the end of the day is for profit, right? So if the principals of the company decide that, all right, we've made our investments, we've done our dues, and this is just time for us now to offer some of our shares to the market, so that the market can, so that you, the shareholders, can just have a piece of it and benefit from it in the ways that they have before, then that's all fine, by all means. Right?
Yeah. Very true. So we get into the matter of what were the gems before we get into the analysis of this company of itself. Some of the gems that we made note of for this one was, the main one was the tax break. That 50% tax break that you're gonna get.
Could just see the 5 year recap.
Yeah, let me bring that up.
Because that's where it really brings it into focus.
Actually, I have it on the chart, so I'll just bring up the chart.
Okay.
And we talk about it from the chart. Tax, or do I? No, I don't.
Oh.
Sorry, guys. I don't have it on the chart. 1 second. I'll find it though.
I think it was near by the top. So once you got to the top of the thing, you just
Yeah, hold on. It was. That's the dividend payout. Too far.
Yeah.
It's remittance industry. Taxes payable. That's what we're looking for, people. We're looking for taxes payable. Okay, not finding it there. Oh, it was below this, It was actually below this. 1 second. Yes, there we go.
Cool.
Right. So, I see it's still scrolling. So right to stop. So I hope everybody can see this, but pay attention to that taxation expense line right here, and these numbers. This is that 50% of how long is it for? How long is it for in the main market?
5 years.
5 years.
Main market, right? 5 years. 5 years. A 5-year tax break of 50% off. Come on.
Yeah, halving that is gonna have a good impact on the company, for sure. Here we go again, tax payable. That's gonna impact these liabilities pretty good. And as a matter of fact, as we were talking last night, you have other high payments, but then for 2018 and 19, you don't have anything as large.
Nothing.
Well, with the exception, of the loans, paying back their loans. There's nothing as high as the taxation that they are paying. So that should be a good impact. Yeah, that should be a good impact for sure. Okay, so we have the taxation, and then the next big thing that we have was the. Oh, but I see. Simon is asking me if I could zoom into the PDF. I missed that just now. What did Simon say? Zoom into the. Tell me the message that he said. Zoom into the
screen. Yeah. Okay.
Okay. Oh, so I'm good now with it like this. Zoomed in like this.
As is.
Okay. Yeah. Okay. All right. Cool. Right. All right. Let me see if I can make this. Nope, that's definitely not it. Sorry, guys.
Yeah, that should be fine.
All right.
All right.
Where we're focusing on. We are assets. So we spoke about the taxation payable. That's a big one. The loans as well, in terms of what they did. That was another tidbit we found. Let's see if I can find it here in the search. Yes, here we go. So in financial year 2020, they did a promissory note for the investments in Alliance Investments St. Lucia of 1.35 billion. And this, in my view, and what we're talking about, has a possibility for, if you know the St. Lucia market in terms of companies that are domiciled in St. Lucia, the taxation over there is low, very, very low. So this could be very positive for them. Though we do know that there's supposed to be changes in their taxation in St. Lucia, but I can't remember when. So forgive me for that, guys. But still, the fact that they made such a big move, such a big investment in the St. Lucia market, tells you that they have well, I won't say in my opinion, it basically shows that they have great interest and great thought about the promise of what this particular entity will bring for them. Right. What else do we have? Oh, I guess we should mention again, Justin, there are 3 main lines of business. There's the Cambio,
Right.
Cambio services,
remittances, and the
payment systems. MoneyGram.
Okay.
And in my view, nothing could be more perfect for them than right now with COVID and the whole digital process of making payments like that. Additionally to that segues into the next strength that I think is that I believe we were talking about, sorry, that we believe was good for them, which was the partnership with MasterCard. That should be
Exactly.
huge.
Exactly.
That should be huge.
That was in around October 2020 when and so little background with the deal with MasterCard is essentially they're partnering with MasterCard to have their deposits. So say for instance, Chike is in America and he's sending some money down to me. I can have my Alliance card partnered with Mastercard. So it has the same debit functions where I can buy things online, and it essentially gives the use of a bank account without having a bank account. So you can upload to this. It's like a prepaid card, has the same ATM benefits, point of sale benefits, online shopping benefits, without you necessarily having to have a bank account for yourself. So
What
this
was
is
the
great for those underrepresented,
Yep, unbanked, and underbanked, which is a huge amount of people out here. Yeah,
Sure.
can't remember that percentage, but I just know it's a lot. So somebody might type it in the chat. I'm sure. I'm going be sure soon. So that's another big one. That's another big prospect. And then this section is the receivables. So this is where they're basically getting their money from. They've got their commissions, cross trade settlements, right? And then of course here's the MasterCard going to work immediately. Nothing was there in 2019. 149 million in 2020, right? Yeah.
Exactly. And you can see the sharp increase in commissions, which means that business was in fact like shooting up in 2020. And so those would have been payables which have since been paid. So those are off the books now. As at this date. I should say that probably would have been as a result of the increase in remittances and from their selling agents, yes.
That's true.
There's been a big buzz around remittances, especially since this year has been such a novel year in terms of people were losing their jobs, people were underworked, of unemployment. So a lot of people had to be supporting from the diaspora. A lot of people had to be supporting from all over the place, sending down money
That's
through
true.
their services. And I believe the figure is around 30% increase year over year in remittances.
From Bank of Jamaica, it was Bank of Jamaica. Bank of
Right.
Jamaica put out that even though we were in the pandemic, the remittance increases were increasing better.
Even though as a result of
That's correct.
direct result. However, their cambio services would have definitely been down. You can actually see that a bit further if you dig into the prospectus a bit, where cambio services have been down because one, tourism has been down, so you haven't had as many people coming into the country spending the foreign exchange. You haven't had as many people freely spending their foreign exchange through the cambio services because a lot of people would have been wanting to hold on to the cash that they had. A lot of people would have wanted to be, especially even the smaller cambios, right? Because their services, what Alliance does is when they're especially servicing their larger customers that you'll find out here in Kingston, Mobile, or wherever, is they'll buy up from the smaller cambios and then bring it together and then sell to the larger entity and then make money off of that spread that they would have gotten.
Right. You're right on the money too, because there it is right in front of us for the PDF where it says companies asset utilization due to its inability to deploy its cash resources in its cambio business. And this is talking about the return on average equity, right? Of the reduction of the return of average equity and why. And they specifically pointed to the cambio business as a result of the downturn in the tourism industry caused by the COVID-19 pandemic. You're right on the money with that.
Yeah, man. Bank of Jamaica was so cautious that they had to institute the 1% dividend payout rule, well, not rule, recommendation to the financial institutions, all deposit taking financial institutions back in April, March, April, thereabouts.
Yeah. It was all shareholders who hold anything 1 million
Yeah,
shares on
so
something like that.
so they recommended to all the deposit taking institutions that they probably should not be paying out dividends to shareholders with anything over 1% stake in the company. And it doesn't sound like much until you really get into that idea of how big NCB, Scotia, JBT,
Yeah.
Sagicor really
Yeah.
are.
Yeah.
So
Yeah.
us retail investors, we didn't have anything to worry about. But for the bigger stakeholders, then yeah, because a lot of those stakeholders would have been out of the country, right? When you think
Hmm.
about an NCB, when you think about a Scotia and so forth, right? So it couldn't just be expending the foreign exchange. It couldn't just be draining the internal reserves of foreign exchange just like that to send it out. But I digress.
Let's see what we have otherwise. I think we've touched that. Oh, yes. And the last one would have been for the long-term investor, value investor like me.
Mm-hmm. The compound annual growth rate was pretty interesting too. I believe I made a note of that somewhere.
Let's bring that up. CAGR. CAGR is the 38%. No, that's after. Well, this is after this is net profit after taxes, and that basically grew this by 38%. But let's look for it before that. Here we go. Well, this is it, right? So between 2016 2019, company achieved a. Yeah, this is good though. You know, revenues of 11%, while the net profits after tax during the same period call this 39% basically, and that's good. That just shows a viable like a business with a strong moat by itself. Like as you dig down into it, you'll see why that stands there. So
It really illustrates how low expenses are for them. How anything after the cost of transactions are for them. Just how low they are.
yeah. And us as the shareholders should take very big comfort in this fact that if we are to become prospective shareholders, should take that they plan to distribute 80% of their annual after-tax earnings in the form of cash dividends. So, yeah, and if you're to take anything off of that, this was their payout ratio before. This is their payout ratio currently before they plan to list. I mean, 80%. So their net profit is 709 million. Let's take 2020, 709 million. They paid out 637 million. That was 89%. Call it 90. So you basically just have to take 10% off of that. So at least what, 500, 600 million, I guess. Yeah, about that. Depending on what the net profit is for 2021.
And they're raising what 1.5 billion, right?
Right.
Yeah, so that's double net profit after tax, which is more than double what the payout would have been. So yeah, big payout day, big year for the company heads.
Yeah. Well, let's get into the nitty gritty now of it. It's a bit on the technical side again, guys, but it's this one you might enjoy a little bit. I mean, I certainly did. Alliance on the side of being. So I'll make this bigger for you guys to be able to see. So this is. Let me just. That's the balance sheet. We don't need to. Actually, we do. We need to start with the balance sheet first and foremost. So cash and cash equivalent. So the cash, they've always had good cash. It's a bit dipped.
Naturally.
Yeah. It's a bit dipped in 2020. You shave off 700 million, 748 million, 733, 30 something million. Yeah, 731 million, about that, give or take. Off of their cash side, but current assets still strong. all the same for the years that they listed. 2 billion in current assets. Liabilities are not running neck and neck like that. 1.6 billion. So their total assets. This is nice. Their total assets is nearly double their liabilities. 2019 was a better year, though. Of course, it was more than double their liabilities, but still, prospective shareholders could take comfort in the equity in terms of what it is. That's $1.6 billion in equity that is available to the shareholders, and of course they put their capital to work.
For sure.
From 2016, we highlighted for you guys 2016 to 2020, they put their capital to work, right? Because their equity growth has just been nice. This on a chart, I mean, it bounces around, of course, but this has been a proper year. In 2020, the equity growth has been nice. 1.3 billion or 1.4 billion between the period, right? In terms of what they added. I mean, the growth rate has been coming down, of course, based on the difference between it, but still, that's still positive. And of course, here are the ratios again. Of course, as they say always, the ratio shouldn't be taken in by itself. It should be compared against other companies. But a couple of the thresholds that I use, I mean, these are what I come out at. But it's not bad, all the same. The strength, they have their strength in their balance sheet. So I have where they really shine is on their revenue generation. Like when we get to that shortly, you'll see.
I don't know if you see the question from Simon.
Yes, Simon is asking, is capital here equity plus debt? No, Simon. This is straight up equity. Equity plus no. Well, not by that. Yes, that is correct. Actually, that is correct, Simon. Or the other formula, which is assets minus liabilities. Yes. You want to take that one because I actually genuinely don't know this one. I saw somebody asking. Well, we'll get to the question in a sec, so we'll remember it. How do you calculate TAJO? So we'll definitely remember that one to highlight it at that time. What else do we have though? But when we go to the charts, is where we see some good stuff. This is the big terms of equity multiplier. So we won't really pause on that one because that would be too technical. But their debt to asset ratio it's trending up, but it actually started to come down. And the fact that they're going to take some money from this IPO, let's see how that impacts them. It's not really that much, but let's see how that impacts them. Debt to equity though, that's nice, nicely trending downward. Even though it started to rise a bit between 2019 and 2020,
we should explain for the investment in St. Lucia.
Yeah, you're right, with a promissory note of $1.35 billion. The things that we like, the current ratio and how debt goes with them, trending upward for their current ratio is looking pretty good. Their equity growth, though, of course, we saw that between 20. Oh, this is an interesting graph, though, in relation, because here we have an explosion of equity, but based on the difference between year on year, the equity growth rate is downward. Wonder what it's going to look like for the new financial year 2020. It should turn definitely and start going back up. Let's see how that goes. Cash ratio, of course, we know they spent their cash putting it to work. So they were holding a lot of cash in 2019. That ratio was 1.18, and now it's down to 0.75. So they're putting it to work. This is what equity versus debt. Of course, with 1.5 billion in a promissory note, of course your debt is going to rise. So, yeah. Cash and cash equivalents, well, that is coming down.
Yeah.
But the trend line is flat. Slightly upward though. Slightly, just very slightly, but it's really flat though. So it's technically flat. For everybody that can see, it's technically flat.
Dropping
but
cash
still they got
flow, as
cash.
I said, is easily explained by the decline in cambio services that would have had in 2020.
Right, right. And then the last part, they put their capital to work. So this is how they put their capital to work. It's just a proper upshot, and we don't expect that to stop. That will continue to trend upward. So pretty much the final part is the sweet spot. I'm genuinely impressed, and unlike well, I should say, unlike other companies I've analyzed, this actually surprises me, or they surprised me. I wasn't able to calculate their gross profit margin based on what was there, but their operating margin is just like wow. Um,
So I'll
make
zoom in
sure.
one. Oh yeah. Just to fill it up a little bit more.
All right. So this is their operating profit margin, 61% in 2020, 72 in 2019, 66% in 2018. This is a company that is not even listed, and they're doing this. As we talked about that last year, remember we were saying they're staying in the lane. They know where they're good at, and they're just plugging away at that diligently. Right?
That's right.
They're just at it. Then the next big indicator, free cash flow. Again, everybody remembers what was the definition of that one. Being able to take money out of the business without impacting that net profit, and that is nice. I mean, by the thresholds that I'm using, by the way, these thresholds are all against the US, and yes, it's very rigid because it's against US companies technically, but still, to find a company after you put it against US thresholds, and this is what happens. I'm loving this. I'm loving this free cash flow, the net margins. Net margins at 48%. Return on equity at 43%. Like as a shareholder, 43 and 50. Your return on assets, 16 and 25. I mean, this is just nice. And then you get down to the retained earnings. Retained earnings, they're holding it down. $1.6 billion in retained earnings, 230% based on the retention ratio, and the 89% payout ratio that they have. I mean,
with that payout, over 200% with that payout.
With that, that's true. That's actually true. 89% payout ratio with a retention ratio of over 230%. That's huge.
Highest payout and highest retention so far. So
yeah.
Just
so guys,
ridiculous.
I mean, in the grand scheme of things, when you look for a profitable company, as I said earlier, if you're looking at against the two big indicators that I've studied, and it makes reference to free cash flow versus return on equity. Here is a company with high free cash flow and also high return on equity. So long term, you can nearly say, okay, you can expect the payments, expect that the management is going to do what is required to keep this coming in, because this is just beautiful. So, I mean, of course, when you put this to chart, though, we should warn everybody that because 2020 year COVID, it's gonna show that dip where it is. So, I mean, we get down to the chart now. We have the operating margins, right? And there it is, 2019. Their financial year for reference, by the way, everyone ends in September. So yeah, so between September 2019 to September 2020, but the trend line is still up. They are still doing good. They just manage their business pretty nicely. And then we have their net income. This is net interest income. I think I actually put the wrong thing here. I'm gonna have to redo this chart because this is supposed to be their net profit against. Can I change it? I can make a quick change for everybody and they'll see. Is net interest income is not supposed to be that. It's supposed to be net income. So give me 1 second. I'll make that change right now, and you guys will get to see that. supposed to be net income against their net margins, and we generate that chart. And I'm gonna have to put that in, but this is their net income versus their net margins chart. So I'm just gonna let me just type that in so everybody understands what they're looking at. This is margins, right? That's nice. That's nice.
Slight pullback. In general, though, point of concerns would be just the general outlook of how the pandemic will be treating us in general, right? Not just us, meaning Jamaica or within the Caribbean in relation to tourism, but also in general when you think about one, where remittances come from, because yes, it is a concern to me that that cases are still on the rise within US and the UK, which is a primary source of our remittances. In fact, for example, news of the news strain and so forth. So that might impact, for example, so you can actually watch things like jobless claims, rate of increase for infections and the general stuff in relation to COVID.
Right.
And the effectiveness of the vaccines which they recently started to distribute. So that is really the indicators for how we're going to be looking come next year. Because if these things continue as they are, for example, I understand why remittances are up over 30% for the year of 2020, but I don't imagine that we'll have a similar rate or even a constant rate of the remittances that we would have received this year in 2021.
You don't think so?
I don't think we're going to be seeing that same level. I'm not saying like another 30% year over year increase. No, I'm not saying. I'm just saying maybe we might not see a maintained level of remittances.
Good point.
Compared, yeah.
I'll add to what you say. I'll add to that for what you say then, because there's two big occurrences coming in 2021 that affect our two major remittance markets. The first one is Brexit in January, if that takes off, and how that is going to impact persons in the UK. And then the second one is, even though there's the presidential change, there's still the walloping COVID situation that is going on over there, and it's not looking good for them. It hasn't been looking good for them.
There's still the election of the Senate, which will then determine what sort of government
stimulus. Yeah, right. What kind of checks everybody can get there, if they can get more stimulus checks. Exactly. To get everybody back here. Yeah, that's
this big debate between the $600 and $2,000, and so it's kind of which way will it go. Although I wouldn't be surprised if it's still stuck with a $600 stimulus, especially if they lose the Senate to the Republicans. That's just me adding some stress test to it.
Yeah. You did make a good point though, and it should be rehashed, that the point that you made with the fact that people were holding back their cash because of uncertainty is actually the same thing I read earlier on as well too for the US. So I would wonder as well too how that would impact the remittance services as well too, going forward into 2021.
Because we are under the impression as a people that 2021, we'll be all good. Vaccine will come, it works, everything works out perfectly fine, and by summer we're sitting pretty, we're looking good, yeah. But I don't always want, as much as I want to be optimistic, I can't let that be my dominant impression. So those are one of the things that I have to look on. That I like to look on.
True. So popping back to the charts, then I mean we spoke on this is their free cash flow to their return on equity. Yes, there is a dip from 2016, but then it's steadily been, there's no precipitous drop off. It's been trending downward, but a bit flat. But still high in the grand scheme of things. As we said, a company that has free cash flow that is above 20% by the threshold that is being used is a very positive indicator. And then in terms of the return on equity, above 40%. Yeah, definitely good. Definitely good for the shareholder, right? Or the potential shareholders.
Can we take a check at the retention ratio? I don't think.
So Simon, I need to go check that back, because Simon was gave me a good insight there that I might have been off, or should I say I am possibly off with my retention ratio calculation. So we need to take a look at that and see if that's right, based against the dividend payout ratio. But this is it as a chart and a graph as it stands now. We have to go look back and see how it changes. The retained earnings has basically been rising, as we said steadily. So when we do the calculations, we'll see how much it changes in terms of the retention ratio against that. What else do we have? Oh, earnings per share. Yeah, I mean, we don't have a price as yet for them, because it's, what are they coming out at? $1.60, pretty much.
$1.59, yeah.
59, we call it $1.60. So yeah, their earnings per share pretty much. But I mean, what else do we have? We have return on equity. We showed how that was coming out. Their return on assets needs some work, because that's trending downward. But we'll see what happens. I mean, 2020 to 2019, COVID. Yeah, that's right there. Right, because it was going up between 2018 and 2019. So
coming out about like 14, 15 times.
Yeah, there's that.
Yeah, quick calculation.
Yeah. Return on investment. We can expect that going back up whenever we turn out and we get past COVID. That's for sure. Without question. What else is there? Earnings before interest and tax. This is pretty nice. And there's COVID again. Between 2018 and 2019, but it's still on
a with when they list that chop off in tax, yeah man, that's sending that back up to
yeah, that's right.
At current levels, that's sending that back up to like 2019 for sure.
Yeah. And then the last thing, well, we have the dividend payout versus the payout ratio. Wow. Yeah. I mean, 80%. I mean, I hope. One would hope, right? One would hope. It keeps going like this, just up. And then we extracted their cash flow from operations, their cash flow from investing, and their cash flow from financing, in which we want their cash flow from operations to be going up, but it's been up and down. It's a bit up and down. What would this trend be? This trend should be saying upward. Even though it's coming down, this trend should still say up. Let's see. Yep, still saying up. Their cash flow from finance. This is debt. There's your 1.3 billion right there.
Yeah, that's that big jump off right there.
That jump right there. That's that. But this is nice though. I mean, they've been investing, and then I guess they've put their money, because this is a precipitous. This is inverse at that too. Oh, I'm sorry. My apologies, guys. This is actually supposed to be what this chart is supposed to look like. In terms of cash flow from investing, you want the company to be actually putting the money to work. So it actually should be, at least by the studies, was a negative value. So this is them actually putting their investing money to work. They're not letting it sit down at all. It's not positive. So that is a, what's this, negative 1.7, $1.8 billion. So yeah, they're putting that money to work. And of course, their cash and cash equivalents again comes over here. So yeah, I think that's it. Those are the main indicators that we would want to look on. Ooh, this one, Justin, did we miss this one? Operating profit and loss versus their EBIT, their earnings before tax. This is going to be interesting. When the 50% drops, you realize that the EBIT is above the operating income, right?
Mm-hmm. Earning more than what standard business is providing for them. So yeah, for sure.
Mm-hmm. Mm-hmm.
For sure.
So yeah,
Good
business.
question from the stands. Jeremy, if you could just like pull up Troyan's question again. So the book value low and earnings per share is low compared to the stock price. We consider this company a good growth stock in a long-term growth industry. Generally, I would say yes, given the given the nature of the Jamaican financial ecosystem. That's one. Two, given the given the depth of how many underbanked citizens are in Jamaica, I believe that the deal with MasterCard is something that's poised for a whole lot of growth. There's a whole lot more room for them to expand into. There's a whole lot more. In fact, there are a whole lot of industries. That's we spoke about this yesterday, Chike.
Yeah.
There's a particular industry within the country which is extremely underbanked because of restrictions due to correspondent banking. And if this is a means, if I would say if this is a means that they can use to then now provide some sort of banking and payment system for their industry, then we could be seeing a whole lot of growth for them.
Yeah. Yeah, but that was a serious speculation, but that would be a big one.
Yeah.
For them.
Yeah, big one.
I guess we were already into the questions and answers. So I don't know what other question. Were there any other questions that were there? Let's see.
You want to take this one?
Our second question would you be expecting growth stocks to trade at a PE similar to their? That's a good question. When we looked at that chart yesterday, basically most growth companies were trading a bit above they were trading above the industry PE when we were looking at that last night. That's a good question. I'm not sure how to answer that.
I don't know if I want to. Yeah, I don't know if I want to. I don't know how to respond to that at the moment. Especially when you brand it as growth stocks, whereas my immediate headspace is to compare it to the other financial companies, right? For example, compared to their PE, which is pretty low at the moment. Example, if you're looking at a JMB, I believe their PE is about like a 10, between a 10 to 12 at this point. So it's trading a bit above them. Oh, hold on, let me actually check that. 1 second.
I'm gonna bring up my sheet and see what it had on it. So but that's a good question. Do you think the company I'll hesitate to say. I might want to guess that it might. Just dependent on where we are going into 2021 and the companies in terms of the overall climate. We could actually see that. We really could actually see that. That would be a plus, though. That would be a plus.
Yeah, for example, because as I was saying, like if you're looking at Sagicor Group, they're at a 12.7. NCB is currently at a 18.7 times. JMB trading at 10 times. So.
But those are the financial ones. Those are the financial. I'm thinking when as a person says growth, I would be thinking I'll be thinking all of those and a lot of those on the junior market and stuff like that. So I mean, with respect to the junior market ones, well, we definitely know some of them are going to be for sure. Like you would expect, like take for instance a meal pack, and I know we're segueing a bit, but you would expect based on what is happening, meal pack. This climate is favorable to them. Fontano, same thing as well too. You would expect you would hazard the guess that is going to be the case. So some will go up, and I guess some will go down. So yeah, maybe not. Who knows? What else? What other questions do we have? I don't see any others.
I think I
see one here. What?
Yeah, I think I kind of touched on some of the concerns relating to Alliance restart. Relating to the restart of tourism. What the cases actually look like. How does that affect people's disposable income to continue to supply remittances going into 2021? You could take a look at the trend of jobless claims if you really want to have an idea. For US, for example, that would be a part of remittances. Cambia, as I said, isn't going to be so hot without actual people coming in to spend their foreign exchange. And then for their card services, which recently got a boost thanks to MasterCard, because they were here before. I just don't think they were co-signed by a MasterCard or Visa card. So
right at the time.
They
were coming along with MoneyGram by itself, and that was it, and that's why I am very optimistic about the Alliance side because of that partnership, because it strengthens, in my view, it strengthens that sector of what they have already in terms of the payments of MoneyGram, inclusive of now getting this partnership with MasterCard, which then they don't have to, they're not tethered anymore to just, they can now expand exponentially outward, right? It's no longer just going to a MoneyGram location or something like that. It opens up a whole bunch of new avenues for them on that payment system side. So
it's a good step forward for fintech, right? And especially for the underbanked people, because a lot of the issues people have in getting a bank account is one, underrepresentation based on where branches are located. For example, if you want to really engage the rural people, the rural side of Jamaica, you're going to have to go over there, and if the banks aren't willing, then somebody else has to be. And it's even if you were trying to get a bank account over there, some of the recommendations, some of the things that you need, for example, proof of income, isn't always readily available. I know that was an issue for me when I was starting out investing, because I always wanted proof of income, and I was a student. Even though I had some money on me that I wanted to invest or that I wanted to join this bank with, I wasn't able to do so. And I figure a lot of Jamaicans have the same issue based on some of the, because we have such an informal economy. There's a lot of people that don't have actual physical proof of income to go to the boss and say, yo, come sign this up for me so we can make a new bank account.
Very true. That discussion actually was happening earlier on today as well too. Versus ease of doing business and getting things like that, like a bank account, and so it's always a topic that comes up that a lot of people are getting left behind. So with something like this is good. I mean,
as long as they can reach them where they are, I feel like it's good. I feel like it's a good, but I feel like there's a whole lot of potential.
And I guess to answer the second side for the Derrimon trading side, we spoke about. Well, we are concerned with. I'm concerned with their debt. That's flat out what it is. I mean, they have taken debt every year, and I am concerned with what they will do in 2021. They have with this APO, they would get a new influx of cash, but at the same time, what are they going to do in 2021? Will they come back to the market again and do another preference share, or will they try to stand on their own 2 feet and improve their revenue generation in terms of their operation expenses, bring that down and try to improve their operations like that across the board. That's left to be seen. Outside of that, what we had a couple of other factors to rehash that for that. Well, yeah, that is the main thing. That was the main thing, because we saw the Woodcats acquisition as being very positive, with the fact that they're the primary pallet maker, and the fact that the industry on a whole for the distribution of products and goods and services requires those pallets to move the different items onto to wherever they're moving them to. So as a monopoly, they have that. We did talk about Select Grocers expansion as well too, because there were only two Select Grocers. There's the one in Manor Park and the other one in Halfway Tree. Sorry, not Halfway Tree, Crossroads. And if this climate favors them, going about. So going about and opening a new one, who knows, but they do want to expand. And then you spoke about, that's the next thing too. There is the expansion to the United States, and if that might impact them as well too, given the current climate. All right, that might be another one. Trying again is asking, Alliance Finance spoke about a possible additional share issue going forward. Are you concerned about possible? No, I am not, because in the grand scheme of things, we didn't get that much anyway.
Yeah, as I said, it's only about like 0.02% has actually been released. Or like general public will hold about 6 to 8%. I want to say, post the offering. So additional liquidity to general shareholders is I don't see that as a downside of things.
Yeah.
Share buyback policies are to the discretion of the company themselves. So it's not a must that must happen. For example, with Cygnus, that is it's kind of the way how Cygnus does business. It's a method to how they want to go about their business. I really can't speak about it too much with that regard, but
Epli does that. Epli is currently undertaking share buybacks as well too. And that's a positive. If a company is doing share buybacks, it
increases the value for you to share.
That's the expectation. So I mean, we should look out for that if they do it, and see that as a positive. What is this? Is from what stir up anything, but any thoughts on
profit taking for sure. Because they have about something close to about 500 million shares through Mayberry Jamaican Equities, and they themselves are open to taking up that same offer. Right, they're very well and good. So, because for example now, they wanted to take up. Say for example now, they wanted to take up some of the shares out of the APO and sell what they feel like selling at that 230. That difference with their volumes between 220 as an existing shareholder and 238 is something. It does be profit taking, bro.
It's just the timing. I don't even want
to. Oh, the timing, I didn't even notice.
Yeah, it's just the time. That's what's been working on everybody's lips right now. Is the timing of this, and the fact that it is lower than the APO price of itself.
Oh yeah, for
real. So yeah, but yeah, I'll leave that one alone. We don't know, guys. We really don't know. Yeah. So, was there any, and did we miss any ones? Any questions that we did? Oh well, thanks Simon for that one. Simon answered the Cager question. Yeah, So, was there any other ones? I don't see anything. Nope, not anything. Everything else was comments, because I wasn't following the chat, guys, while I had the screen up. So I'm glad you get put on the spot just said, not me, because I know nothing of what's going on. I'm just following what we are seeing on social media, guys.
I'm learning as we go along.
So yeah, as a matter of fact, for me, I find this is the first time this has ever happened though, because I'm new to the market of investing. I can't remember something like this ever happening before, where the broker of the IPO for the company, because they were
they
in
were.
the IPO, decided to dump their shares in that way. I mean, that's why timing is the discussion on everybody's mind. We don't know. Listen, this is the nature of the game. They can do it, and that's what they're doing. If you feel that
Trust
Derrimon
me.
trading, at the end of the day, as I said it, we must always remember the market price of the company and what we perceive to buy the company for has absolutely no impact on what the company is actually doing in terms of how they are performing. So if you believe that the prospective growth of the company is going to be much more, then you should make your position known. Forget about the noise and analyze what is going on, remove the emotions out of it, and make a prudent decision with the guidance of your financial advisor and all of the information that is there. The thing about it, when you have stuff like this happen, people react, and we know that people react with emotion, like, oh, they're trying to dumb down the price of the company and so forth. If the company performs exponentially next year, what you've just sold off all your shares, and then the price doubles over. I mean, then you have to rush to buy back in, right? And you might be buying back in at a higher price. It's all investor sentiment at the end of the day, and you must know what works for you. So my only advice is just tune out that noise. Tune out that noise, you know.
Focus on what it is. Focus on the company as is. Remember, we're trying to buy the companies, not the stocks. So focus on where they are, where they're going to be, and don't get too caught up on 1 and 2 cent differences, especially it comes down to where you're buying it. If you're trying to make a decision between where they want to buy on market, where they want to buy from Mayberry, where they want to buy from the actual APO pool, it's all up to you. If you wanted to buy in the first place, if you saw the value there, then continue.
Yeah,
don't
that's
get
true.
too caught up on that. And once again, I really doubt Mayberry is going to be selling off any huge portion of and completely reduce their holdings, you know. So that's the way it goes.
We got two comment here. We got Romain's comment there. Big up Romain. Yo. We got MoneyGram here. They have the feature of people overseas. Yeah, that's what we were talking about.
Yeah.
Right.
As a selling agent for MoneyGram, Alliance does in fact get a commission fee from that, which would have translated to the increase in commissions that we would have highlighted earlier on in the video.
Yeah, so that's. I mean, they're just plugging. As I said, in my view, they're just plugging the different areas. And in a way, they're pivoting, because if remittances don't work out for them, they've got a payment system where they are now tapping the unbanked and the underbanked, and getting persons to basically be able to move that money around. So yeah. Wait, or is that not like there's not a 10 million?
Out of the 494 million, whatever.
Yeah. Well, let's see. It's gonna be an interesting couple of days to come. I mean, as in
For sure.
The
market getting exciting again. Lovely.
Yeah, it is. I did say it today. I said that today. I said it's been an interesting day with everything that happens. So this is what you want to see, though. This is get your feet wet, guys. I mean, if you haven't bought in, don't miss this train. I mean, regardless of what's going on, learn and just step in the water and participate.
There's always some fresh excitement. Trust me.
Yeah.
Some fresh excitement that could potentially be profitable for you.
That's very true.
Like entertainment that pays you.
Yeah.
You know, it's crazy. Yeah.
I'm gonna leave a little tidbit, and that's what I was thinking about actually 2 days ago. And you just touched the main topic. Segue. You said entertainment. Coming out of this pandemic, when it's done, based on how Jamaica is in terms of parties, etc., I have the feeling that we should keep a close eye on main event, because it's just going to light up for them. But that is coming out of the pandemic. It hit me like 2 days ago. I was like just thinking like, okay, everybody is so like, everybody wants to get out, but we can't get out. When we finally get out, there are gonna be parties like Wild West, like, yeah. And it might be something to really think about in truth, in terms of how it can capitalize on that.
But yeah, let's see what 2021 has in store for us, guys. Final couple of days of the year. Perfect time for some reflection. Perfect time to set your goals, make note of what you want to achieve, how far you want into achieving it, and how you can make next year even better year than the one before.
Couldn't have said it better. Anyway, guys, I think with that, that will bring us to the end of this. This is a very exciting discussion. I like this. I like how we did this. It's an exciting discussion. I hope everybody really got.
I hope persons were able to follow. at the end of the day, hopefully it wasn't too much information for them. But yeah, guys, I wanted to ask you before you go, in general, what's your outlook for next year? And it doesn't have to be like, don't make it specific to any company, but just kind of what you're expecting in terms of the market. Because remember, we started this year, persons were like, market may not do so well, possible US recession, things like that. Then COVID kind of took that off track a little bit. So nobody's really thinking about the same thing they were thinking of at the start of 2020. So what's your personal outlook for what the market may have in store for us for next year? And it's hard to say, of course. This all can change tomorrow morning.
I'll let Justin go first.
Okay. I am expecting more acquisitions, as just putting that out there, number one, right? There's still a lot of room for acquisition of companies which couldn't have necessarily held on for as long. There's going to be a lot of room for alternative financing industries. The alternative financing industry should be looking good next year. I'm expecting to see a continued. We're still going to be on the path of online services, online retail, still on that online path, So it's still, in general, it's not going to be as pronounced as 2020 with the shift that we would have had to endure, but we are definitely approaching the new normal. So trust me, whatever would have been on the uptrend might have a bit of a pullback, might have a bit of this, might have a bit of that, but there's still a lot more to go. There's still a lot more. So those companies that would have been amassing cash, those companies that would have been positioning themselves for new deals, then 2021 is the year for that.
Yeah. For me, I zoom out. I would zoom out on the whole economy and how it impacts us. I'm keenly looking at what's going to happen with Brexit, with the UK, and also the incoming president for the United States and how it is. But in my view, I'm still positive, and I'll say this: it has. So for my overall investments, and I think I mentioned this to Jermaine sometime back, my overall investments took a huge hit in March, and the main one that took a huge hit, I didn't expect it to come back anytime soon. It's not only recovered, but already shot past and performing at its best right now than it was before. So for me personally, going into 2021, I am positive about the news of the vaccines that are there. And basically the engine restarts once the top level countries, the richer countries, restart their engines. So the faster the EU bloc can get back on track, the faster UK can get back on track, US can get back on track, etc. Bodes very well for Jamaica. If you're playing with the Jamaican market of itself and looking at it primarily, but still overall, I still have high hopes for 2021 for the overall markets. I still believe that we'll turn that corner, but we should basically take our guidance from the powers that be in terms of the finance minister, the Bank of Jamaica, etc. When we look on the Jamaican market, in terms of when they expect our recovery to be, that's between 2021 2022. If it happens earlier, great. If it doesn't, you prepare accordingly. But I'm still positive about the fact that come 2021 we should turn a good page.
Okay.
Sure.
For me, I would say let investing principles guide you. And what I mean is, watch things like your time horizon. How long are you holding that stock for? What's your aim? If your aim is short term and to take profit, then you need to research and kind of navigate the landscape that way. If you're holding long term, it really doesn't matter what happens in the day to day. Like just average down, maximize things like dividends and things like that. Reinvest if you can. If you can't, then don't. Because I think that a few things I'm watching. The real estate market, I'm still waiting for some of those prices to go down.
Yeah.
Yes, because they remember the loan forgiveness, I think should be ending soon or has ended or something like that.
Oh yeah.
Yeah. So there are persons who would have been hanging on by a thread that may not be able to still sustain going into next year. So that may have an impact. We don't know which companies would have been, just bleeding out cash. What that may lead to opportunities for lenders, but depending on the type of company, their operations, things like that, there may be some activity there. And it's just really, if you let those investing principles guide you, meaning invest with a certain time horizon, be sure that you're investing what you can afford to not necessarily lose, but understand the difference between unrealized loss or gain. So if it is that you have not sold, you can't realize the loss. But if you need the money, you need the money. You may have to absorb a short-term loss. So things like that, be mindful. So something that I do that may help some persons. Usually this time of the year, I'm looking to rebalance my portfolio. I'm looking at how it performed. I'm looking to see which companies can sustain what they did throughout the year. I may choose to take some profit. I may choose to shift certain positions based on what I see, the company is doing. It doesn't mean I won't ever buy them back, but it's making that shift because of what you anticipate the market to do. It's better to buy when everybody else is selling, and it's better to sell when everybody else. Yeah.
Be greedy when there's blood in the streets, and be fearful when everybody is greedy.
Exactly. Right now, I'd actually like today, I'm looking at some stocks that are trading at some very nice prices because everybody is focused on IPO and APO. So now is when I buy, when everybody is selling. And I say nothing, I just kind of watch it. And then a month or no, 2 months from now, when persons are talking about the stocks that I'm buying, no, I'm good. So that's how I trade. So take that for what it is. It's not. Yeah, you notice we didn't say any specific stock. It's just really how you trade.
It's a pretty fair assessment, I'd say, because grand total between the Cygnus APO, Derrimon's APO, Alliance, and even with the key rights issue, that's a lot of money being raised. So some people who would have, say for example, I know some people would have exited some positions, or at least partially, to enter into Cygnus or Derrimon or so, and or Alliance. And with the delays, that's so with that sell off right there, there's going to be
Yeah.
less attention on some of these stocks, more attention over here. All in all, with some added liquidity toward the
Yeah.
general market.
So even before today, some persons would have been planning to sell. I'm sorry for those persons who may have put in sell order to try and get into, for
Alliance.
example, the Alliance when they have more time. You know,
About
so
4 weeks to sit down with it.
yeah.
I hope the stock don't run and leave them. Yeah.
I mean, just for me, I really I don't view IPOs and APOs the same way as other people. I think that sometimes when the market set when the company sets a price for the offer, to me the market always, well, in some cases go down to that price anyway. So I found that I don't have to apply for the shares. I can just get it on the market. Because if the market knows the price is going down, sometimes it just kind of finds its way there at some point. It doesn't have to hold it for long. But if I see an offer price of 140, I'm putting in an order for 140, and chances are that gets filled before the offer is even out. So then I can just sit and wait, and I'm good.
Yeah.
Yeah.
Very true.
All right. All right, guys. So I think we have done justice to these two offers. If there are any questions, feel free to leave them in the comments below. I want to thank Chike, thank Justin. Justin, yeah, when we first spoke about this, discussion, our partnership a few months ago, it's definitely worked out well, I think. We've really found value in having these discussions with you. Hopefully, our viewers, well, I think they feel the same way, because we've
For
been
sure. For sure. For sure.
definitely growth on our platforms. I just want to say, everyone, if you want to reach Justin, you can find him on Twitter, on Instagram. For Chike, it's at Guyanese TV on Twitter and IG. And for me, I don't really talk investment as much as these guys, honestly. I kind of like to sit and watch and learn from them. So you can follow me, but it won't be for investment stuff. If you follow Learn, Grow, Invest, then you'll get investment content there. I focus on things from a very high level. I like to learn, so I'll listen to the experts. But thanks everyone for being here. Thanks for watching. Please share the video. Please like the video, and we will likely have our next meeting maybe a week after next. I wanted to get a break, like a 2-week break. So hopefully we get that in. If not, our next meeting should be about the 13th of January. We have I like to say an all-star lineup for next year. So we'll see how the first few meetings go.
Can't wait.
Yeah.
Yep.
Yeah, should be good. All right. So take care, everyone.
All right, guys.
It's a pleasure.
Take care. Take care.